Hello, welcome. Thank you ever so much for everyone coming. So we're going to talk a bit about how to position your portfolio for retirement. I would if the clicker works. It does. Really, we want to talk about income investing for this presentation. So really, when you're in the accumulation phase of your life, you're probably taking slightly higher risks in order to try and generate higher returns from your investment. And you benefit from time on your side to ride the ups and downs in the stock market. But once you hit the retirement stage, you need to think a bit differently with your investing. You really need to think about perhaps reducing some of the risk in your portfolio. You might want to switch to income-paying investments. You may even consider taking some of your money and potentially putting it towards an annuity. Or the option is you can actually just keep your investments, keep them in the market and hope that you still achieve capital growth and you get some income as well in retirement. But really, it's all about thinking about how much can I actually generate from income and how am I going to do it? So on the slide here, there's some examples of the yields you might get at the moment from different types of investments. You can get about 0.7% for UK government bonds. The FTSE 100 is probably yielding about 4.5%, and commercial property is about 5%. The thing that strikes me is that I can remember in sort of living memory how easy it was to get 5% from a cash ISA. And it sort of shows how today you really do have to work quite hard to get that level or even anywhere close to it. So once you're in retirement, there's various ways that you could go about collecting this income. The first is natural yield. This is where you're relying on your investments to give you dividends, and you just take these dividends to pay your bills and fund your lifestyle. You don't need to sell any shares to do this. You're literally just scooping off the dividends. So if we take the example of an insurance company, you invest in its shares, you put £20,000 in, and it's yielding 5%. So in a year, you collect £1,000 in dividends. So you don't need to sell any shares, so the following year, you still got the same investment there, and it will generate another £1,000, potentially a bit more if the dividend is growing as well. But what you do need to think about is focusing on what's actually happening to the value of those shares at the same time. So if they're falling, you can get into a situation where the point where you want to start selling some shares, selling some capital, your capital is starting to be eroded. So you do need to monitor your investments even when you're in a natural yield environment. So the alternative is to sell capital. So sell small chunks of your holdings each year to generate some income. Now, I think the key here is if you've got other sources of wealth, this might be a possible route for you to explore. It doesn't necessarily mean that you need to always seek really high yielding investments. If I looked at the most popular funds at the moment, I can see Fundsmith on there. I'm sure many of you in this room might hold it. I think people like to own that in retirement for its investment process. They like the idea of investing in high quality businesses. But actually, it's only yielding 0.68%. I mean, I can get far better than that go to any building society or bank and on their cash savings accounts. But it shows if you're doing the sort of the selling capital strategy and you have other forms of wealth as well, you don't necessarily have to go into high yield stocks.
So we're going to talk a bit more about kind of the investment things that you need to look for when you're investing for income later, but I thought it would be interesting to look at the kind of levels of income that you can take from a pension pot. And so we looked at an example of a £300,000 pension pot, if you just click on, and looked at how long it would last if you took different levels of income. So typically, quite often when people think about the level of income that they want to take in retirement, they tend to think of the amount of money that they would like and maybe equate it to the annual salary they took when they were employed. But in a way, you need to reverse engineer it and look at how long that pot will last for and how long you need it to last. So if we take this example of a £300,000 pot, which is actually quite generous, the average UK pension pot is less than half of that. So we've taken an example of someone who's saved quite a bit throughout their life. We've assumed that you get 5% return a year after fees, which is kind of broadly in line with what markets have delivered over the long term. So if you took £40,000 a year, which some people might think is quite a reasonable amount to take in retirement, it might be less than they were earning when they were earning an income. That money will only last you for 9 years. So if you retire at a normal age of 65, that money is only going to last you until you reach 74, which if you look at current life expectancy today is not going to be enough for many people. If you cut that down to £30,000 a year, then it's going to last you for 13 years, so slightly longer, and that might be enough for some people. If you took £20,000 a year, then it's going to last you until you're almost 90 if you retire at 65. So you can see there that that's probably a more realistic income to be taking. And then if you cut it right down and you just took £10,000 a year from that pot, it essentially lasts forever because the growth that you're getting on it each year more than outweighs the amount that you're taking off it. So you need to think about how other sources of income that you've got, and so how much you can afford to take and how quickly you can afford to deplete your pension pot. But you also need to think of this in the round. So most people will have state pension, you might have other investments, you might have investment properties that are giving you an income. So you need to think about it in its entirety and the income that you need. But that example was kind of in an ideal world where you get 5% returns a year every year, and we all know that markets don't go in a straight line upwards. So I redid the figures, but looking at what happens if markets fell just in the first 2 years. So in the first 2 years that you're taking income, the markets fall and your portfolio falls by 5% a year after fees. And then after that, it goes up by the same 5% a year that we'd modelled previously. And you can see that the impact of those falls in the early years when you're taking your income, the impact that that can have on how long your pot will last. So in the £20,000 example, you lose 6 years off the amount of time that you can take that income for. And so the lesson here is really to be flexible with the amount of income that you're willing to take from your retirement pot. So rather than rigidly sticking to that number because that's what you've decided you need to take each year, you need to think about the implications of any market falls or portfolio falls might have had and kind of readjust every year and look at whether that's still a realistic income. Obviously, in certain examples, it might be that markets have shot up and you can afford to take a little bit more for a couple of years, but it's about not being so rigid and sticking to a fixed number. And so another good example when you're starting off working out how much income you can take, even if you don't want to go down the annuity route, which lots of people now don't want to, they want to keep their money invested in retirement. It's always useful, you can get a quote quite easily online of what an annuity, what you'd be able to buy with a pot. John Travolta's here because he is 65. And so it's always good to get an example of what you could get from an annuity, and that can help realign your expectations of what income you could take each year and give you kind of a starting point to work from. And so then we want to look at some of the next steps. So when you're looking at investing, some of the things that you need to look out for. Equity income investing has been in the spotlight a lot this year. I'm sure everyone will have heard of the Woodford situation where he saw lots of redemptions from his fund. The fund was then suspended and subsequently closed, and it had a knock-on effect. And I think rather than being fearful of the impact that this has had and rather than writing off the entire sector, what we can do is learn some lessons from it that apply across the equity income sector, but also across investing generally. So if we go through these. So the first one is investment drift. So when you're looking at your portfolio, whether it's when you're building it up for retirement or whether you're taking an income from it, you need to be mindful of your fund manager changing the style. So we buy a fund and a fund manager because that fund manager has an expertise in a particular area, whether that's investing in Asian companies or whether that's investing in UK small companies. And you've bought that expertise and you don't want them to drift from that, because if they start drifting into another area of investing, it's very likely that there'll be another fund manager that's more experienced in doing that you would want to shift your money to. So you need to keep checking that their top holdings on the fact sheet, for example, haven't changed dramatically. You need to check that they're sticking to what you believe that they would invest in at the outset. The other thing you need to do is understand the style that they're investing in. So different managers will invest either to a value style or a growth style, or various different styles. And understanding the style they're investing in helps you to understand when they're going to underperform and what kind of market conditions they're likely to do well in and do more poorly in. And this means if you understand that, then if they have a period of underperformance, you understand whether that's justified because of the market conditions or whether it's because something else going on at the fund management house or with the fund manager. The other thing that you want to do is to spread your eggs around. You want to diversify your money. It's very easy to buy a fund and it can deliver you high returns each year and you continue to buy it because you think, well, this is making me lots of money. But actually the far more sensible thing to do is rebalance each year, take some of your profits from that fund and buy back into the ones that haven't performed so well but that you still have confidence in. The last thing you want, particularly if you're reliant on this pot for your income in retirement, is to be too reliant on one fund manager, one fund management group, or one fund particularly. Another good rule for life, but also for investing, is not to follow the herd. So just because your friend has made a lot of money with a particular fund or fund manager, that doesn't mean that you should too. So having conversations with friends about what they're investing in can be a good starting point to get ideas, but you need to make sure that you do your own research and you thoroughly investigate what you're buying before you buy it. And the final thing is to be careful of very big funds. And this is very difficult because there's no rule of thumb on how large a fund should be. It really depends what they're investing in. So if you're investing in very small emerging market companies, then you'd probably want that fund to be much smaller than if they're investing in giant FTSE 100 companies. So it's a judgment call. And with all of these things, you can always ask the fund managers or the fund management group themselves. They're there to run your money. And so you shouldn't have any fear about getting in touch with them with questions or getting answers to things. So earlier on I was saying you could get 4.5% from the FTSE 100. So it led me to think, well, how can I go about beating that level of yield? So I had a look at the market. I looked at 2,300 funds and found 64 open-ended funds, so unit trusts and OICs, were yielding 5% or more. And then a further 128 investment trusts and venture capital trusts were doing the same. But how is it that they're managing to beat the index of the FTSE 100? So that's the 100 largest companies on the London Stock Exchange. I found some common themes, and they were investing in, quite a lot of them were investing in things like emerging market debt, aircraft leasing, mortgages, and small business lending, and retail property. So if you had your money in these sort of funds, you would have to think, well, I've got to be comfortable with taking a high risk to achieve a high yield. Otherwise, do look what's in these funds and how they're achieving their yield. Because I do think some people may not be too comfortable being in those sort of areas of the market. So another way that you could beat the FTSE 100 is to go with funds that have give some examples here. In the name, they tend to have things like enhanced yield, income optimizer, income maximizer. And what they're doing is the fund manager is trying to generate an additional source of income through the use of derivatives so they can top up the dividend payments. And some of these funds you can see here, they're yielding more than 7%. Now, if you were interested in these types of funds, you must understand the process by which the fund manager is achieving this extra top up. I do suggest you do lots of research or talk to the fund companies themselves about how they're doing it, because it's not for everyone and there are downsides to it. So the other thing that you need to be conscious of when you're income investing is that a lot of that will be reliant on dividends. So if you take out the example of the funds that Dan just talked about there, which rely partly on dividends and partly on kind of complicated derivatives, broadly, as an income investor taking natural yield from your portfolio, you're going to be reliant on companies paying out dividends. And there's a lot of concentration in the UK market particularly. So the top 10 dividend payers in the FTSE 100 account for more than 50% of all of the dividends paid out by FTSE 100 companies. So you can see that there's a lot of concentration in these big payers. And so one thing that you need to look at is the sustainability of that dividend, so how often it's going to be paid out. And so I ran some research looking at dividend cover of companies. So if you're new to this phrase, it's looking at how long earnings of a company will cover the dividend for. So ideally, you want dividend cover of 2 times. So that means that the earnings will twice cover the dividend payout each year. Now, this is just one measure of dividend sustainability. There are lots of others, and it's certainly not necessarily a cause of panic if the company doesn't have that level of cover, but it's an indicator that perhaps the dividend that they're paying out might not be sustainable. And so we can look here at the 10 highest yielding shares with dividend cover of less than 1.5, and you can see that there's some quite meaty dividends on offer there. But then when you go one step further and you look at the number of those that are held within UK equity income funds, so the concentration and the reliance that those funds have on those dividend payers. So 30 of the funds among that UK equity income sector, the entire sector, 30 of those funds have 5 or more of those previous dividend danger zone companies in their top 10 holdings. So their top 10 holdings being their largest 10 positions in the fund. So that's, again, not necessarily a reason that you need to sell that fund, but it's something that you need to be aware of. And just 5 funds in the entire sector had no exposure to any of those companies. And a couple of those were funds that invest in other funds, so they wouldn't show up on the data. So it's about making sure that the sources of those dividends and of that income is sustainable and that they're not too concentrated. But like I said, you don't need to automatically avoid these funds, and that dividend cover level doesn't necessarily mean that the dividend is definitely going to be cut. I think it's also worth bearing in mind that fund managers will allocate to different groups of income payers. So they may well have some that are very high payers today that help provide the income for today, but they might not necessarily grow significantly in the future. They'll then have another group where they're paying a more moderate income level, but they've consistently increased that payout above inflation every year. So they're kind of the steady eddies, the constant payers. And then they'll have the dividend payers of the future. So these are the ones that maybe aren't yielding so much now, but have high growth potential and are likely to see large increases in their dividends. And so fund managers might have allocations to some of those high yielders that I talked about previously, but if that's balanced out on the other end by allocations to some of these other groups, then that's okay. But I think it's just about being aware of your exposure to that. And particularly, I think that's the case if you've got exposure to more than one equity income fund. So say you own 3 funds and they've all got really high allocations to those companies. That means that if you're relying on those for your source of income, they're very reliant on maybe just a handful of companies. And if one of those were to cut their dividend, that could have a big impact on your income. So it's something that you need to factor in when you're picking funds and when you're picking stocks.
And so another thing to consider when you're looking for income-paying investments is don't pick a fund simply based on the frequency of the dividend payments, such as a monthly dividend paying one. Now, having monthly dividends would be really useful. It's almost like replicating what we had in our working life with the monthly salary. But I find that you really do need to look at the investment style of a fund, look at the risks involved, what's the fund manager's track record, and just investigate it in the way you would normally look at individual funds. I'll give you the example of SQN Asset Finance on the screen here. So this was one of the first investment trusts to launch with monthly dividends. And initially, there was a lot of excitement about it. It got into a few troubles with some of its underlying investments, and that's why the share price has been falling. So even in the difficult times, it did still pay dividends, but you get to this point where your capital is being eroded, which is not quite ideal as an investor. So if you do look at monthly dividend paying funds, I would check how much they pay each month. Most of them will give you the same amount for the first 11 months and then whatever's left in the pot for the 12 months. But there are some funds that give you variable payments. So what you had one month won't be the same for the next month. Now, imagine if you set up a direct debit for one of your bills and it's the same amount of money each month. Well, you don't want to get in a situation where if you're relying on one of your investments to cover the cost of this bill, where 1 month or 2 months you might not even get enough to cover that cost. So I just want to talk finally just about some passive investments. So I'm sure many of you are familiar with ETFs that track major stock market indices. So it might be if the FTSE 100 goes up by 2% in a month, well, the value of your FTSE 100 ETF should do exactly the same. But I think underappreciated is the rise of ETFs that are tracking income characteristics. So on the London Stock Exchange, there's 3 products here which just caught my eye, covering different themes. So iShares UK Dividend will track an index of the 50 highest yielding funds, but you must be careful with high yield could be a result of a falling share price. And so these actually could be companies that are undergoing some serious problems. That's why the market's pricing their shares down. The Spider S&P UK Dividend Aristocrats, well, that tracks an index of 40 highest yielding stocks, but it also makes sure to be in its index, you've got to have been a company that's consistently maintaining or growing its dividend for the last 7 years. That's a bit better filter, but it's worth pointing out it's not a perfect investment. Carillion used to qualify for this index that it was tracking, but that company quickly got into problems and then ended up losing investors all their money. And finally, there's BMO MSCI UK Income Leaders. This again tracks high-yielding companies, but it also looks at quality filters, like looks at the balance sheet and consistency of returns. Unfortunately, this product's shutting down early next year because BMO are pulling out of the European ETF market. I just wanted to include it in the presentation today to give you an idea of how the ETF industry is finding ways to evolve and give you different ways of looking for stuff. So Laura and I present a podcast every week, which the type of things that we've discussed today we'll do in the podcast as well. So please do give that a listen. It's on Spotify and the Podbean platform. Just type AJ Bell Money and Markets, or you can listen to it on the AJ Bell website or the Shares Magazine website. Thank you ever so much for your attention, and please do enjoy the rest of the day. Thank you very much.
Thank you.